Can you guys hear me, please?
Yes, good morning, Mr. Gypsy. Can hear
Good
you.
morning.
Okay.
Good morning.
Good morning. Morning. I think we can start. Time is already fast spent. Okay. All right. So first of all, I know in the last class some people said they wanted time to go over some stuff again. Did you have time to do that? Do you have any questions? So I think the first question is, did you have time to go over it? That's the first thing. Okay.
Hi,
That
Mr.
is not.
Gypsy.
Yes.
I went over it,
Can you hear me?
and
Okay.
I don't know if it's possible for us to go through the question in the curriculum. Last class, I had to leave early, so I don't know if you guys did that. It's just one question.
Did you hear me?
Yeah, so we did do we have time? Okay, let's see. I know we're talking about we answered one of the questions and some people said they were not so that was this one, yes. So some people said they had some issues understanding and blah blah. I think Damilai was part of them. Okay, so can someone run us through this question? Let me see if we understand it. Any other person? Ini or Michael? Any of the
Good
Michaels?
morning. I should read the question.
It's not just to read the question, it's to answer the question. So, okay, so you can read and then explain what it is the question wants us to do. Then we now
Okay.
dive into, yeah.
Okay. So suppose that both a call option and a put option have been written on a stock with an exercise price of $40. The current stock price is 42, and the call and put premiums are 3 and 0.75 respectively. Calculate the profit to the long and short positions for both the put and the call with an expiration date stock price of 35 and with a price at expiration of 43. Okay, so he's asking us to calculate um how much each person, like how much the person that is buying the put option first. I think there are like different scenarios here. So how much we profit or how much we lose if the price goes down to 35, and that is lower than the exercise price of 40, and also if it's at 43, which is higher than the exercise price of 40, and also the same thing we have to do for the call option. So the put option is option a right to buy for no obligation. So it means if the conditions is not favorable for him, he will probably not buy it and will just lose his premium. I think that's what the question is about.
Okay, thanks. That's clear. Um, so in this question, we're asked to calculate a couple of things. So the question says that there's an exercise price of 40. The current stock price is 42. So as at today, the stock price is 42. Then we spoke about premiums. So there's a call premium and there is a put premium. So meaning we are calculating for both call and puts. Now, then they now say we should calculate the profits to the long and short positions for both the put and the call with an expiration day stock price of 35 and with a price at expiration of 43. So what that means is we've been given two stock prices. So if the stock price is 35, what would be the call and the put? And then if the stock price is 43, what will be the call and the put? That's what they've asked us to calculate. Now, did I mention long and short? And remember, I said don't be confused about long and short. Just remember that short means sell. So long would mean buy, which is the opposite. Okay, so you are asked to calculate. So let's take the first one, $35. So the first thing they are asking you to calculate is, okay, there's a call. Somebody is buying that call. Somebody is selling that call. For you to buy a call option, it means somebody has sold it to you. So you that you are buying the call option, what does buy mean? Buy means long, right? Sell means short. So one person is buying a call option, one person is selling a call option at $35. Then that same $35 will now assume a put option. So in that put option, one person is selling a put, one person is buying a put option. So using $35 as an example, you have 4 scenarios, and then you duplicate that for the $43. Okay? So, Michael Angelo, can you give us one of the answers with explanation, of course? So we have said there are 4 options for $35. There are 4 options for $43. So you tell me the option you have chosen and then why you are picking an answer. Michael Adioti, hope I've not murdered your name. Please, can you give us an answer?
Yeah. For the call option, who is the buyer? Yeah. So when the stock price is at $35, he will prefer not to exercise his rights anymore. And but by not exercising that right, he will be having a maximum loss of $3 that he has paid already in form of the premiums. And then for okay, I'm with you, sir.
No, continue.
Okay, all right. But still on the call option also, when the price is at $43, he would prefer to exercise his rights because at that point in time, the exercising his rights seems cheaper than getting that same stock from outside his arrangement that he has had earlier.
Okay. Thank you. Very good. So, so that's correct. So the reason I took so much time on this call and put, or these first 2 readings, are that they are like the foundation of everything we are going to do. So I'm glad at least you guys understand what we are doing. So for maybe Esther's sake, for the so let's go down. So the first thing is you ask yourself a question. What is a call option and why am I going to exercise or not exercise a call option? So a call option, like we have said, is the right to be able to buy something in the future at an agreed price today. And we have said that the reason you are going to exercise that call option is if you let's say you have your left hand and your right hand. You have the left hand, you have a price you've agreed with someone 3 months ago, just like we used the Instagram example and all. But if you ask me, I would just advise that to help you have 2 prices in your mind. Just for example, have 20 naira. Let's say you want the price, the exercise price, which is the agreed price 3 months or 6 months ago was 20 naira. And today the price is 30 naira. Then you ask yourself, would I be happy to go and buy that stock at 30 naira when I can buy it at 20 naira that I've agreed with somebody before? So based on that, you know that, okay, yes, I'm going to buy it at 20 naira, which is the agreed price in the option. Therefore, I will exercise the option. Meaning you are exercising the option because the share price or the underlying price today is more than the price that you agreed 3 months ago. So it makes sense for you to buy at a cheaper price. So if we are looking at these examples, so the first one, when the stock is at $35, you are buying a call option. So the call option gives you the right to buy in the future. So you have to compare two prices. I agreed to buy at $40 before, but today the price is $35. It doesn't make sense for me to still honor that $40. So I will go for the $35 today. So if I go for the $35 today, it means that my call option has no value. The value of that option is 0 because I did not exercise it. So what does that mean? I am only going to lose the $3 that I have paid as premium. If you remember our examples, we said there's a cost to this option. Because you have a right, the other person does not have a right. The other person has an obligation to fulfill his own part. So there must be a price to pay. That person cannot just come and lose everything. So meaning you have paid a premium. And this question tells us that the call premium is $3. Meaning that for the call option, the person that bought the call option has paid $3 to the person selling the call option to him. So in that case, based on this, we said the option has no value because I have said I am not going to exercise that option because it doesn't make sense for me. So if I don't exercise the option, the only money I will lose is that $3 I have paid the seller of the option to me. So this question now says, because this question asks you to explain the two sides of it. Sometimes the question will just say, explain one side, which is your side, which is the person that has bought the call option. But now the question says, I want to see both the person that has bought the call option, which is a long position, and the person that has sold the call option, which is a short position. So I want to see the two. And at the end of the day, we have said that an option, the two of them must be equal. So if one person is losing X, the other person is gaining X. So if automatically we've said that the option owner will lose $3, it means automatically the option seller has gained $3, which is the premium that was paid. That's basically what this one is saying at the top. So if I still go ahead with the call, so the call at $43, remember long call means you are still the one buying it. But now the price is now 43. So you ask yourself again, I agreed to buy something at $40 3 months ago. And today the price is $43. I'll be thanking God that I made that agreement 3 months ago. So what does that mean? I will honor my option. So I will exercise it. I will exercise it, meaning that I will buy at $40. Right? So I will exercise that option. But my cost in that option is $3, which is the premium I have paid. So I'm gaining $3 between the 40 and the 43, which is the price I should have bought in the market is $43. But now I'm buying at $40. So I've gained $3. That's a benefit to me that bought the call. But if you remember, I paid $3 in the beginning. So $3 minus $3 will give me 0. So that's what this is saying. The buyer paid $3 for the option and is now in the money by $3. Hence, the net profit is 0. So in this case, I am not making any profits because the value of the premium I paid is exactly equal to the benefit I have gotten. If, for example, the price of this option was $45, just for the sake of it, it means that my benefit will be 45 minus 40, meaning I have gained $5 based on this option I have. Then I will take out the $3 premium, which gives me a net benefit of $2. So in that case, I have $2 extra. So same way, if you flip it, short call, the seller already has the $3 that I paid to him as a premium. But now he also has to go and look for $3 to buy that asset and give to me. That means $3 minus $3 is 0. Therefore, he too is not gaining anything. You obviously don't even need to calculate this because, like we said, the opposite of one is the opposite of the other. It's just vice versa. But To understand the calculation, this is how it is. So don't be confused by the short or the long call. Like I said, the long is the person buying. So the person buying the option. So you are either buying a call option, which is a right to buy, or you are buying a sell option, which is the long put, which is a right to sell. So don't be confused by the long. Then the S, just remember, S short is equal to sell. So the other person is selling a call option to me, or the other person is selling a put option to me. Okay, so the same applies to the puts. So for the puts, we said that in this case, why am I entering into a put option? You ask yourself the question. I'm entering into a put option, which is a right to sell, because I believe that the price in the future will come down. So I want to agree a high price with you today, so that when that future comes and every other person is buying at a low price, I'll just generally walk into your shop and say, Oga, I'm selling this to you based on that price we agreed 3 months ago. So I will get more money by selling to you. So if we see the first example, it says if the stock is at $35. So if stock is at $35 and I have agreed to sell to you at $40, what does that mean? It means as a business, as a rational person, I'll prefer to sell to you at 40 than to go to the market and sell at 35. So meaning I have gained $5. Because we have both agreed that we sell to you at $40 and the market price is 35. Me, I've gained $5. But remember, I paid you a premium of 0.75 from the beginning. So my net benefit is $5 minus 0.75. The same way, the opposite of it, the person that sold me that put option, the moment I gain $5, he has lost $5 automatically. And then he will net that $5 from the premium that I have paid to him. So he has a loss of 4.25 while I have a gain of 4.25. That's how it is. And then the same for the $43 as well. Is that fine? Esther, is that fine?
Yes, it's clear. Thank you.
Okay. So I take it everybody is good. Okay. So may have to run today. Okay. So this is basically just something you should read on derivatives, benefits, risk, issuer, and investor use. We've spoken about this as well. So some of the advantages of derivatives is one, ability to change your risk allocation, ability to transfer risk, and ability to manage risk, basically. So remember, we have said that these derivatives is trying to take a position similar to the underlying position. But in some cases, you prefer to take this position because it may be difficult to get that asset. The stock itself may be hard to get. So you decide to take a derivative. Remember, a derivative is deriving its value from the stock, from the changes in the stock. Okay? So we have discussed these benefits in our introduction. Some examples of ways that risk exposure can be altered using derivatives without any cash market securities are: the portfolio manager can increase or decrease exposure to the risk and return of a market index. Manufacturer can hedge exchange rate risk. We've spoken about this one. This is the one we used examples for. That we said you are getting money in one currency and you are in a different country. How do you hedge that difference? What do you do to ensure that you minimize or eliminate the risk of that exchange? Okay, so I'll just run through most of this because they are just things you need to read. So there's information discovery, there's operational advantages, and then improved market efficiency. The risk of derivatives, you have the implicit leverage, the basic implicit leverage just means that because it's not cash, it's not a cash market, there is leverage in it, there is a bit of debt in it that is implicit in the derivative. Then you have basis risk, you have liquidity risk, counterparty credit risk, systematic risk. I'm just trying to run through all this because these are just things you should read up. Then derivative uses by investors. So basically, just take out time to read this because it's just basically things you just need to read and understand. Okay, so arbitrage, replication, and the cost of carrying pricing derivatives. So we'll get into a bit of calculation here again. So one of the things, I kept mentioning call, put, and how you need to understand what they mean. Because at the end of the day, it's important you know what it is that why somebody is going into a call option, what it means for the person if the price of the assets goes up or comes down, whether I will exercise it, and blah, blah, blah. Okay? So there's arbitrage opportunity. So if you remember, we said that for any of the options or any of the contracts, forward contracts or options, you are taking up a position today in regards to a position at a future time. So there is an assumption that the future price will be a particular thing. You know the price of the asset today, which is the spot rates. You also have an idea of what the future rates will be. So there's a relationship between that future rate and the spot rate. So what that means is I can go into a contract today based on a particular rate because I expect that the future rate will be something else. So what arbitrage opportunity says is I should be able to get the same assets. What is happening in one market must be similar to what is happening in the other markets for the same assets based on the same conditions. If not, there will be what you call arbitrage opportunity. So let me explain. Let me use a real life explanation. So you know the way fuel price in Lagos is different from fuel price in the north or in the east. I don't know some of the prices in the north and all, but there's the price you sell in Lagos is not the same price. Or the price you buy in Lagos, buy fuel in Lagos, is not the same price you buy in other locations. Why is that? The logical thing is that because of transport costs. So the closer you are to the source of the product or the raw material, the cheaper it is. And the farther you go from there in terms of distribution cost, the more expensive it is because you have to transfer that distribution cost to your final consumers. So in that case, it is logical for the price of fuel in Lagos, I think about 580 or something, and then the price in maybe the east or the north, let's assume it's 700 or 800, for example. So what arbitrage means is, in this case, the difference between that price in the north and the price in Lagos should be equal to any transportation costs for moving it from Lagos to that location. If it is not equal, what you will discover is that some people would be willingly moving it from point A and taking it to point B and getting a benefit. What does that mean? I can take it from point A at 500 naira, I buy it from Lagos, and I take it to where it is sold at 800 naira. So I have a 300 naira benefit. If my transport cost and the normal profits is equals to 300, then it's fine. But if in a situation where I get, let's say transport cost is, just for the sake of examples, transport cost is 100 naira and my profit is 50 naira, for example, 150. It means that I have an extra 150 that is like extra profit. So already this is a juicy market. I will just be moving it from one Lagos to the north, Lagos to the north, Lagos to the north, and be making extra 150 for basically doing almost nothing extra. So that arbitrage opportunity is that's what is called arbitrage, basically. So the idea is if I pick an asset today, and I let's say I have an asset today of 200 naira. The spot rate today is 200 naira. The future rate is going to be 300. Everybody knows future rate is going to be 300. But if I take that 200 today and I go and invest it somewhere within the same time period, and I get, for example, a 350, it means that I can gain more than the person that has kept that asset to be able to get the future rate. So let me just read this so that I don't confuse you guys. Okay, so in contrast to valuing risk assets as the risk-adjusted present value of expected future cash flow, the valuation of derivative security is based on a no arbitrage condition. Arbitrage refers to a transaction in which an investor purchases one asset or portfolio of assets at one price and simultaneously sells an asset or portfolio of assets that has the same future payoffs, regardless of future events, at a higher price, realizing a risk-free gain on the transaction. So you are buying one asset at one price, and at the same time, you are selling a similar asset. So the two assets are the same. They have the same expected future output. But you are able to sell the other one at a higher price. So there is an arbitrage profit. But arbitrage is a short-term thing because once everyone realizes that you are making extra money in that chain, everybody moves to doing exactly the same thing you are selling. If in economics, we mentioned pure water as part of one of our explanations for perfect competition. And we said, because there's no barrier to entry at the beginning of starting a pure water business. Of course, the first person or the first few people that started pure water business were making a whole lot of money. So everybody was, these people are making good money, these people are making good money. Then people started coming in. So as they are coming in, they are reducing the profit that is available to be made in that market. So that's the case. So once there is more like an abnormal profit to be made in the market, people start taking actions because everybody cannot see profit and they will not take action. They start moving towards enjoying that profit until that profit disappears and then the market goes back to perfect information. Let's put it that way. So that's what this arbitrage is saying, basically. So while arbitrage opportunities may be rare, the reasoning is that when they do exist, they will be exploited rapidly. Therefore, we can use a no arbitrage condition to determine the current value of a derivative based on the known value of portfolio of assets that has the same future payoffs as the derivatives, regardless of future events. So what that means is we should be able to say, if I have two assets, if I take one asset, the two assets, A and asset B, they both have a future, return, the same future return. Meaning if I take the two assets, if they both have the same future return, then they must have the same price today. Meaning if I sell asset A, I must sell it at the same price at which I sell asset B. Or else, people will say, if asset A if I'm going to get $100 from asset A in the future, and I'm also going to get $100 from asset B in the future. But if I sell asset A today, I will get $20. And if I sell asset B today, I will get $25. People would naturally tilt to selling asset B because it will give them more money. Basically, that's the concept of that. Okay. So we can illustrate a no arbitrage pricing with a 1-year forward contract with a forward price of F1 on Acme shares that pays no dividends and is trading at the current price of $30. So portfolio 1, you buy a pure discount bond with a yield of 5% that pays at year 1. The current cost of the bond, so to get the cost of this bond, because you have to get the present value. You have to get the present value. So the present value is 1 divided by 1 plus R. So your R here is the rate. So that you have 1 divided by 1 plus R, which is 1.05. Additionally, enter a forward contract on 1 share as the buyer. The forward has a 0 cost, so the cost of the portfolio is 1 over 1.05. So if you buy a share at $30 and you hold it for 1 year, the cost at the point when you are buying the share is $30, of course. But the no arbitrage condition requires that the two portfolios with the same payoff in the future for any future value of the shares have the same cost today, which is what I said. If asset A and asset B has the same future expectation that they will both generate X, then it means that they must both have the same cost today. If they don't have the same cost today, then people can tilt to buying one and selling the other to make that little arbitrage difference. Okay? So because our two portfolios have a payoff of S1, they must have the same cost to prevent arbitrage. So in this case, the arbitrage price is, which is, if I know the future value is $30 and I know the rates, so I'll just do future FV divided by 1 plus R, which is the future value divided by 1 plus R, so I can get the present value. So the present value is 31.5. So those two assets must cost 31.5 today to be able to generate $30 in the future. So this now says, okay, let's look at two examples. We have identified what the cost should be. The cost and the price should be 31.5. So what if, so to better understand the no arbitrage position, we'll consider two situations in which the forward price is not at its no arbitrage value. So if it is greater than 31.5, or if it is less than 31.5. So the first one is if the forward price is 32, which means it is greater than 31.5. The profitable arbitrage is to sell the forward because the forward price is too high. The price should be 31.5, but now it's 32. So you sell it and make money. But remember, you have seen a benefit. So when you are selling this price, as you are selling it and you're selling it and you're selling it, you discover that you have, and of course, as you keep selling and selling, what happens is the price starts coming down. So at some point, this 32 will drop back to the, let's call it equilibrium price of 31.5. So we can also view this transaction as borrowing. So you are borrowing $30 at a risk-free rate to buy the share. So today you say, okay, I want to go to the market. I borrow $30, and then there's an interest rate or a risk-free rate of 5%. So you invest it at that 5%, and they will give you 31.5 to settle the loan. So while you are paying 31.5, you just collect your 32, which is the forward price, settle the 31.5, and you get 0.5. So let me take that again. I think this one just explains everything basically. So we can now view this as borrowing $30 at the risk-free rate. So you go and you borrow $30. You borrow $30 and they tell you that the interest rate is 5% for 1 year. Meaning at the end of 1 year, you need to pay them 31.5. So what would you do? And you know you have a share that in the future, the cost is 32. So what would you do? You would collect this loan. When it's time, you pay your 31.5, but you already have 32 that you are collecting. So 32 minus the 31.5 gives you the 0.5 benefits that you get without doing any extra thing. You have not spent any extra money. That's what this no arbitrage position means. And then it works the other way around as well, which is the opposite. So if the forward price is less than what it should be, what you would do is you buy the forward so that in the future you get 31.5, and then you sell the shares today so that at the end of the day, you get a 0.5 net difference. Though we'll still look at examples on it later. Do you understand it? Is it clear?
A little bit from here, but I guess by the time we start with questions, I will get a bit.
Okay. All right. Then we have the replication. So replication is creating a portfolio with a similar situation as the derivative. What does that mean? Let me just summarize, because all this, what you need basically, because there are a lot of things, we call them jargons, but a lot of things that are here that you actually don't need for your exam. Okay, so for the replication, the forward price that will prevent an arbitrage. So you need, remember we have said we don't want arbitrage. We want the forward price to be equal to, which is, I have an asset. The price it will be in 1 year time should be equal to the price of if I go and borrow money and they charge me interest. The money I'm going to pay back in 1 year must be equal to the price of this asset in 1 year time. So that there is no arbitrage. There is no way somebody will say, oh, you sell one, we will sell today and buy tomorrow. No, they must be equal. So the formula to get that is when you say your forward price equals to your spot rates, which is the rate as at today, plus 1 plus risk-free rates, raised to power time. So your risk-free rate is rate of return that does not include risk. For example, treasury bills rates. So if you go today and you say you want to go and invest your money in treasury bills and your money comes out, you are certain that there is no risk in it. But if you take your money to MMM, for example, and all those other means, there are risks to it. Yes, the returns will be higher. Remember, the higher the risk, the higher the returns. So the returns for those ones will be higher. Therefore, the risk is higher. But this one you call a risk-free rate. I'm sure you also learned this in some of your other courses in CFA. The risk-free rate is the rate, as the word says, that is risk-free. My return is sure. My return is certain. That's the idea. So in this case, we are using it to assume that you take in, remember the derivative. The derivative is I am agreeing something today for the future. So I'm saying, okay, on one side of the equation, I'm saying I want to be able to sell okay, let me use a call. I want to be able to buy a particular asset at so price in 3 months' time. That is my derivative. That is on the left side of the equation. On the right side of the equation, which is this replication, is I must have something on the right side that is equal to the left side. And how do I balance that? It means that I have to say, okay, what is my spot rate today? And then apply a risk-free return on it. So that whatever I get as a figure must be equal to the figure of my derivative on the left-hand side, so that my equation must balance. Is that clear?
Please, can you take it again, sir?
Okay. So I have an equation. One on the left side, one on the right side. The equation on the left side is my forward, which is what we have been talking about before. The equation, the one on the left side, that's what we have been talking about before today, which is I want to carry out a deal. I have agreed a price with somebody and I've said in 3 months' time, I will buy so stock or so assets at a particular price. which is the exercise price, which we have been talking about since. Based on that, I have a value of my derivative, which is, for example, 50,000 naira. Now, okay, yes, the asset today costs 40,000, for example. I want to be able to buy this same asset for 50,000 naira in 3 months' time. That's my equation on the left, which is my forward contract. But now we are saying that to ensure that there are no loopholes, that everything is balanced in terms of equilibrium, everything is equal. On the right side of the equation, I have to ensure that I'm able to get, using today, today, that 40,000 that I've said today, if I pick that 40,000 today and I apply a risk-free rate on it, using the same time period, which we have said 1 year or 6 months, using the same time period, I apply that interest on that 40,000. I must get the same 50,000 as I have gotten in my forward for it to be balanced, for there to be an equilibrium. If I don't get the same figure, then it means that there is what we call the arbitrage opportunity. So that's for arbitrage. So it must balance. Do you understand?
Yes.
Okay. Let me see if I can, because this people are a bit silent today. Okay, let me see if I can explain this in a different way. Okay, so this says, in the case of a derivative contract whose value is derived from future cash flows associated with the price of an underlying asset, arbitrage opportunities arise either if two assets with identical future cash flows trade at different prices, or if an asset with a known future price does not trade at the present value of future price determined using an appropriate discount rate. So the idea is that I have two assets. Remember, there are two sides to the equation now. There's one side, there's the left side, which is derivative, and there is the asset itself. Remember, the derivative is deriving its value from the asset. Don't forget that. Derivative is deriving its value from the asset. So I'm trying to get the asset on one side, the derivative on one side, and the asset on the other side. And it must balance. I must balance it out to give me a net difference. That's basically what that is. There's an example here. Let me see if that example can help. Okay. So let's take this example. Okay, so Proclam Investment entered into a contract to buy 100 ounces of gold at an agreed price of 1,792 per ounce in 3 months' time. So this 1,792 is the forward price. They've agreed that in 3 months' time, I will buy this asset at 1,792 naira. They've agreed the price today for the future. So meaning this price is the forward price. Now, in this example, Program does the opposite trade, giving a discrepancy between spot and discounted no future gold. Assume that today's spot price is 170 per ounce. So today now, remember we have said derivative. So the derivative is on the gold. So in this example, the underlying asset is the gold. But they've entered a derivative that, okay, in the future, I will buy gold at 1,792. So is this a call or a put? Let's start from there.
It's a call.
Call.
Thank you, it's a call because you have agreed to buy a call. So working in that direction, what will make him exercise or not exercise the call? Okay, in fact, they said the price is 1770. So if the current price is 1770, would he exercise the call or not exercise the call?
You won't.
Sorry?
You won't. You will not exercise it.
Okay. So he will not exercise because it is lower than the price he has agreed.
Yeah.
So exactly. So that's I just wanted to bring that into this, but still in that direction, because everything call and everything we're talking about is on the left side of the transaction. You know, after there are two equations here. So we have said the future price is 1792, which is also the exercise price in terms of option. The price today of the gold itself is 1770 per ounce. So somebody is now saying, okay, let me look at it this way. One person has entered a forward contract, right, to buy gold at 1792. Another person on the other side has the gold itself. So the question is, this person on the right side that has the gold, is there a way he can invest, sell the gold, invest the money, and get higher than this person that already agreed a forward contract? That's the idea. So we are trying to look at the two sides of the equation. If he can get more, then there's an arbitrage, there's a problem. So the replication, the word replication is, we have a forward contract on the left. We want to replicate buying or selling the assets to balance the equation so that the two of them are equal. Okay? So here we have said the price today is 1770 and the annualized risk-free interest is 2%. That means that we know that this asset today is 1770. If I invest this asset, I will get 2% on top. So for the purposes of this example, we assume it can borrow at a risk-free rate and gold may be stored at no cost. Okay. Under these conditions, we demonstrate how we can generate a riskless profit. So we have three things here. One is we have the price of gold today, which is the spot price, right? We have the forward price, which is 1792. And we have said that the forward price, where is it? So remember this formula. We have said the forward price must be equal to the spot price times 1 plus the risk-free rate raised to power t. The t is the time in 12 months, basically. So we come back to this. What is our spot rate? 1770. That's the price today, S0. What is our risk-free rate? 2%. What is our time? Our time here is 3 months, which is basically 3/12, right? And then what is our forward rate? 1792. So meaning that in my formula, I'm going to do 1770 times 1 plus 2%, which is the risk-free rate, raised to power 3/12. And when I do that, I should be able to get this 1792, which is the forward price. That's why I said the two sides must be equal for there not to be an arbitrage. So yes, I have a forward price on the right, but now I have the gold price and I have a risk-free rate. So if I invest or if I borrow money and they ask me to pay a particular interest, which is 2%, if I pay 2% on that 1770 based on the period, the figure I get must be equal to this forward price at the same period. Do you understand?
Yes.
Okay. So if we now go down, so that's what you see here. 17, they've just multiplied it by 100. But 177 times 1.02 raised to power 0.25. I want you guys to calculate this. I want to be sure that press your calculator and tell me if you are getting exactly this figure.
Yeah, I got the same thing.
Okay. So is there anybody that's getting anything different so that we discuss? So we discuss it now. Okay, I'll take that as no. But just for the sake of future people watching this video. So you must do the 1 plus r raised to power. So 3 over 12 is what is 0.25 basically. You must do this part of the equation first before you multiply it by the 177. Just for, it's important you have that so that you don't make mistakes. Okay, so in this case, they have gotten one. So remember, they've just multiplied everything in this question. You just multiply it by 100. So it's the same numbers. The only difference is they multiplied it by 100. Okay, so in this case, you have 177878. This is lower than the 179213 that we said is the future. So what that means is on the left side of the equation, somebody will get 1792.13. And on the right side of the equation, somebody will get 177878. So meaning the equation doesn't balance. So proclaim riskless profit is equal to the difference between the forward sales proceed and the loan principal. What does it mean? It means that in the 1 year time, when 1 year comes, he will collect his money from this forward. He will collect 1792 or 179,213. Then he will take that money and go and repay the loan he has collected of 177,878 and make a profit of 1334. That's what this is saying. So he is good. But this is an arbitrage position. And this is a position that we have said will only last for a short time. In all these stories, what you basically need is the formula, which is this spot rate times 1 plus risk-free rate raised to power time. That's basically what you need. The rest are just plenty stories. I remember we said derivatives is not as high a percentage as the others. So you need to find a way to be able to be quick about it and to be able to know the things you need for the exam, basically. Okay? So this is saying we have derived that position. But now, is that clear? Do you guys understand it now? Any questions?
I understand it.
Okay. All right. So in that first assumption, so the first thing we are taking out from there is we've spoken about arbitrage, we've spoken about replication, and we've spoken about the formula, which is the most important thing, which is the future price, which is this FO, future price at whatever time, that's the T. So it can be 1 year, it can be 6 months, is equal to the spot rate today times 1 plus risk-free rate raised to power T, the same time of the forward rate. So they are both the same time. So this is assuming that there is no arbitrage. So if the left side is equal to the right side, it means there is no arbitrage. Now, remember the left side is the person that has gone through the forward. Okay, so let's go back to example of phone. I think it was phone that we said Ini is buying from Esther. Yes. So remember, Ini is buying the phone, but Esther is the one with the phone itself. So let's assume that let's assume that yes, Esther has the phone and then Ini is the one buying the phone. So they have said that we have said the forward price on one side must be equal to the spot rate if you go and take a loan, basically, and they tell you this is the interest we'll charge you on that loan. The money that you are going to pay them back must be equal to the money you are going to collect from the forward contract. That's basically what that is. But now there is something that we call cost of carry. What does that mean? Because the person is carrying the assets, there are things that come with that asset. So if you have shares with you now, there are things that come with that shares. For example, dividend payments. So dividend payments are a benefit to you who has the shares. Right? So meaning that as long as I hold these shares, I will keep getting dividend. So what does it mean? It means that if I own the shares and somebody on the other side is trying to calculate a forward price on those shares that I own, to be able to balance the equation, you need to take account of that dividend I'm collecting. And that dividend is a benefit to me. So because I'm getting that benefit today, it will reduce the price that I'm going to sell it in the future, in quote, because I've enjoyed from it. So let's use what asset can I use now? So can someone think of an asset that you own and then you enjoy benefits from it over time? Any example?
I think maybe stocks that pay dividend.
Yes, stocks. I want to use, okay, good. Let me use a house. I wanted to use a different example from a stock. So let me use a house. You buy a house today for 1 million naira and you get rent on it. You get rent on it every year. Let's say 100K. So first year you get 100K, second year you get 100K, third year you get 100K. So if somebody is coming to buy that house from you in the next 2 years and somebody wants to calculate the price, the person will basically say, okay, if I want to calculate the forward price of this asset, give or take all other conditions are unchanged. Those you that you are selling the assets, those rent you have collected are a benefit to you. So if you are going to sell it in the future, you are willing to say, okay, I've collected rent of 200K now. Okay, I can sell it 1 million minus 200K, 800K. I can sell it to you for 800K. Do you understand? Because you will say, okay, even if I add the 2 years rent I've collected, I still get the 1 million I bought the assets. It's still fine for me. So because you are expecting to get benefits in 2 years, so you bought the house for 1 million. Year one, they paid you rent 100K. Year two, they paid you rent 100K. Somebody is now trying to value that asset at the end of year two to say, okay, how much would this guy be willing to sell it? So if me, the owner of the land, I may be willing to sell it for 800K. Let's assume other conditions are unchanged. I may be willing to sell the asset for 800K. Why? Because if I look at it, I'll say, I will get 800K. I've already gotten 100K twice from rent. So if I add it back to that 800K, I'm back to my 1 million naira cost of the asset after 2 years. It pays me that I'm still able to get 1 million naira for this asset that I used or that I've used for 2 years. So what does that mean? In the case of a benefit, it reduces the price of the forward. Do you get? Because I'm going to enjoy benefits from that asset, I'm willing to reduce the price I will sell it in the future. Then let's flip it the other way. Let's assume that I have that same land, and for the last 2 years, I've just been paying, for example, I've been paying to government. Nobody has come to take the house. I've not been able to rent the house out. I've just been paying costs, land use charge, LOMA. I've been paying everything for the last 2 years. If you come and ask me how much I'm going to sell that house to you, first of all, I can't sell it to you at 1 million naira. Because all the costs I've paid for the last 2 years, who is going to bear it? It's not me. It's definitely not me. It will be you. So what would I do? I will add all those costs, all the land use charge, all the lawman. Let's say everything is 100,000. So add the 100,000 to 1 million. That's 1.1. So the minimum value I will say to you is 1.1. So that at least I will even recover my costs and the value of the assets. So I say, okay, at the end of the day, it gives me 1.1. 100K goes for all the costs. I get my 1 million back. I am okay. So what I'm trying to explain to you is that for costs, it increases the forward price, which is the future price. But for benefits, it reduces the future price. Do you understand my explanation? Is it
I
clear,
do.
guys?
Yes.
Okay. So let's go to the notes. Okay. So for this one we have done, we didn't assume any cost or any benefit. So now we are bringing in cost. So any additional cost or benefit of holding the assets must be accounted for in calculation of the no arbitrage forward price. There may be additional cost of owning an asset, especially with commodities, such as storage and insurance costs. For financial assets, these costs are very low and not significant, okay? There may be monetary benefits to holding an asset, such as dividend payments for equities, which we've spoken about, and interest payments for debt. Holding commodities may have non-monetary benefits, referred to as convenience yield. So what you just need to know about convenience yield is that you have benefits, but it's not monetary. If an asset is difficult to sell in the market, owning it may convey benefits in circumstances where selling the asset is advantageous. For example, a shortage of the asset may drive prices up temporarily, making sale of the asset in the short term profitable. What you just need to know here is that the convenience yield is the non-monetary benefits. That's all you need to know. Okay? So we have said that, okay, so here we see that the cost of holding an asset increases is no arbitrage forward price. This is the one I just explained to you using that example. Example of the landlord. Any money I've spent, I will want to regain it in the future. So meaning my forward price will be higher because I'm going to add the cost of holding the assets. Clear? Then for the benefits, it is the other way around. Okay, so let me see, is there an example here? I want to, okay, let's use this example. So I want to explain this to you carefully because many of these formulas are a bit confusing. So I just want to break it down for you guys. Okay, so we have said consider a stock index trading at 1550 with a dividend yield of 1.3%. So the first question I'll ask you is, dividend yield, is it a benefit or a cost?
Benefits.
Good. As a benefit, is it reducing the forward price or increasing the forward price?
Reducing.
Reducing. Okay, very good. So have a dividend yield here. When the risk-free rate is 3%, continuously compounded, calculate the no arbitrage 6-month forward price of the stock index. So the first thing I want us to do now is calculate it without this dividend yield. Let's assume there is no benefit, there is no cost. We want to calculate what the forward price will be. Remember, we want the forward price we'll calculate now. We want a no arbitrage forward price. So we've been given a stock value at 1550, and we are saying that if we invest it at 3% for 6 months, we will get X. So what would that X be? So can you guys calculate it? Let me know what your answer is.
Sorry, Mr. Chooks, did you say we should compute it without the dividend yield? Is that what you said?
Yes, ma'am.
Okay. 1573.43.
Okay. Any other answer? She's not correct, by the way, so I'm waiting for someone that is correct.
1562.
They're also not correct. Somebody else.
Please give me 1 minute.
Yes, please.
Yes, please.
1596.5.
Wow, another
Wow,
answer.
another
Okay.
answer.
All right.
1573.42.
I've gotten 4 answers. There are only 3 people on the call.
No, this is a new 1573.42.
Is this your first answer? Is this the first answer you're giving me?
Yes.
Okay. So your answer is the same as Esther's answer.
I don't know if I'll answer.
Yeah, that's the same answer I got.
Okay.
Okay. So, Michael, can you tell us how you got your answer? Then we go to Esther and then Ine.
Okay. The risk-free rate 3%. I assume it is per annum, and you were to calculate the no trade forward price for 6 months. So what I simply did was to divide the risk-free rate by 2 to get the half year. Then I did 1 plus 1.5% raised to power 0.5, then multiplied by stock industry.
Did you say 1.5%?
Yes, I divided the 3% by 2 since we are to calculate the 6-month forward price.
Okay. Okay. Esther, run me through what
Okay,
you did.
so because it's continuously compounding, I did E raised to power 3% multiplied by 0.5. 0.5 is 6/12. So once I put 3% times 0.5 and I did the E of it, I got something. Then I multiply it by 1550.
Okay. All right. So first thing is for Michael. Yeah, so you're not supposed to divide the risk-free rates. So the idea is the period will always change. If you remember the formula is S open bracket 1 plus RF raised to power T. So that T would always change. The risk-free rate will remain the same. So you have 1 plus 3%, which is 1.03, raised to power 6/12. 6/12 is 0.5. So 1.03 raised to power 0.5. That will give you one part of the equation, and then you multiply that by 1550. Good?
Yeah.
Okay. For Esther, I don't want you to be confused by this E. So I would prefer you stick to the formula itself. So where you have raised to power, it's easier to remember that because that works for everything we are working on majorly. So don't be affected by this continuous compounding. Don't worry about that. What you just need to do is pick your stock, which is 1550, multiplied by open bracket 1.03, which is 1 plus 3%, raised to power 0.5. You will get 1573.07 or something. So you would always be correct in that line. what will be different between what is different between what I have and what you have will just be the fractions after the decimal point, which you don't need to worry about. But it's important you are consistent in the calculation, because you've used E now. In another example, you won't use E. You will use raised to power. Do you understand?
Yes, I do.
Okay. So just stick to
You're saying I'll
the
get the same answer. That's what I think.
yes.
Uh,
So try my method, and you
But
should.
then
So
different
my method.
decimal.
Yeah, it's just the decimals
Okay.
at the end, which you shouldn't worry about. But why I
Okay.
prefer you use this my method is that this is the method you will keep using till we are done with the course. No matter the example, once you use this, you are good to go. But in some cases, you would not have to use this E. So I don't want you to have to cram more things than necessary. Just use the main one that you need, and then you're good to go. Okay? So based on my calculation and your calculation, that's Esther and Amy, we got 1573, right? That is a situation of no cost and no benefits. That's the forward price with no cost and no benefits. So now this question says there is a benefit. A benefit which you people have said, we have said that dividend yield is a benefit. And you have said that what happens to benefit? We take it out. So because this dividend yield is a percentage, 1.3%, we are going to take this out from the risk-free rate. So your risk-free rate minus this percentage. So the same formula we have done before. The only difference now is that we are taking away the risk-free rate. Sorry, we are taking away the dividend yield from the risk-free rate before we do the raised to power 0.5. So can you guys do that and tell me what you have? I hope I've not confused anybody.
So I have a question. How do I do raised to power in my calculator?
So you should see x. You should see something like x raised to power y somewhere. Do you have that? You will see y on top of x, like x is carrying y.
What
Do you
I
have
have here,
that?
I have x squared. I have 1 over x.
Is y
You
raised to
have
power x above 9? The key
Above
above that.
9.
Yes.
Oh, okay. I've seen that.
okay. So what do we have as our answer? I will give you some minutes.
1563.
1563.12.
In how are we still getting different answers?
Yeah.
I also got 1563.12.
That's what I got. So Ini, how are you getting? What did you use, Ini?
I got the same answer.
No, you said 1563.4.
No, I said 0.12.
Oh, okay, 0.12. Okay, sorry, my bad. Esther, did you get the same answer?
I'm still doing it. I'm not getting the same answer. Just give me a second.
Okay, but Mr.
What?
Chose, I have a question.
Yes, please.
Because when I was going through the material, so they give us different formula, one for discrete and one for continuous. But you said we should just ignore the continuous and we should use the discrete. So is it not going to affect anything?
I've told you what it affects. If you use this other one, you are just looking at the decimals, the decimal place, 2 or 3 decimal place, which you can do without. It's still the same. Like now, we did this same one. We got 1563, right? It's just that
Yes.
ours is 0.12 and theirs is 0.23.
Okay.
That's the only difference. So I don't want to confuse you with having to learn too many formulas. So I just want you to stick with the discrete one, which is which will take you to the destination, basically. Because your options will act, what the options you will have will be 1563. They won't give you option with dots, with the decimal places. Do you understand? So your answer, whether you use this or use the other one, you are still in the same line.
Okay.
Yeah. And most of the examples are actually discrete. So once you learn the discrete, I think you're fine. You can decide to learn the two if you want to, but like I said, this course is only how many percent? I intend to just take you direct to what you need so that you have space in your head for other more important courses in quotes. So the fewer things you have to learn here while passing, the better for you, basically. Okay? Esther, are you there now?
I still haven't got it, so I just want to confirm. So it's 0.
You know what? Tell me what it is you have. Run me through what you are pressing on the calculator.
I did 3% minus 1.3%, which gives me.
No.
You say no? Okay.
I said no, yes. This is not what you did before now. We said exactly what you did before. The only thing is that you are removing the dividend yield. You didn't do 3% before, you did 1.3%, right?
Oh, okay. Okay. I get that. I think that's where I messed me up.
So you should have it now. Can I hear yes? This your yes
Just
is
give
not
me a
strong.
second. Just give me a second.
Okay. Okay, so while she's doing that, so if it was a cost, can you guys tell me what the figure will be?
What is going on?
If the instead of dividend yield, let's assume it was a cost, what will be the price? So Esther, you wanted to say something?
Okay.
No, please, you can go ahead. Sorry.
No, I've given two of them what to do. It's you, I'm on your matter now. Do you have the figure or not?
I want to write it down. Maybe it's because I'm not writing it down. Sorry.
Okay.
If it was a cost,
Mm-hmm.
the figure will be 1582.97.
All right, good.
Yes, 1582.97.
Okay, good. So to take it back, while we wait for Esther, we've gotten three figures now. The first figure we got was the figure without cost or benefits. We got 157 something, right?
1573, yes.
Exactly, 1573. We now said if there is a benefit, and we said what does benefit do? We take out benefits, which reduces the forward price. So you now say that the benefit falls from 157, sorry, the forward price falls from 1573 to 1563 because there is a benefit there which we have taken out. Do you understand?
Yes.
If we now flip it to if there is a cost, we said the cost to be added to it. So it now moves from 1573 to 158 something that you have calculated now. So you see that there's an increase in the forward price because of the cost. So an exam can ask you, for example, you can have a question that says the forward price has risen from 1 to 5. What will make the forward price go up? You have to know that what has taken the forward price up is because there is a cost, or you get. So you have to know that part. CFA will not come, in some cases, will not come directly to ask you to do this one. You have to be able to know that, which is why I gave you the example of the landlord. So the benefits is taken out while the cost is added to the future price. Important, very important you note that. Esther, are you closer to us or you are
Sorry,
now
Mr. Chief,
farther?
maybe you can just tell me what to write, put on my calculator, because I'm not guessing it.
It's funny because you got the first one. I just say you should add
I
something
mean,
to what you did the first time.
oh, am I adding? Oh, sorry,
Sorry, deducting.
no,
You
no,
are deducting,
just
sorry.
tell me.
Okay, so
Even if I deduct, I'm still not getting. Okay.
So let's take it bit by bit. So either you want to put everything in the calculator once, or you want to do it separately. As you
Okay.
as you go faster, you can decide to put everything once by putting brackets. So the first thing is the risk-free rate, which is 3%, which is 0.03 decimal points, right? So 1
Yeah.
plus 0.03, that gives you 1.03, right?
Yes.
That is
Okay.
on one
That's
side. Now, I want to
okay.
remove this dividend yield from it. This dividend yield is 1.3%. 1.3% in decimal is 0.013. So what am I going to do? I will do 1.03, which I've gotten before, minus 0.013.
Okay.
That gives me a figure.
Okay, I've
After doing
gotten it.
that figure I've gotten, I will now do raised to the power of 0.5. 0.5 because
Yeah.
it's 6 months, which is 6 over 12. So once I have gotten that one, I will now multiply all this, my answer, by
All right.
1550. Clear?
Yeah. Yes. Thank you. I've gotten it.
All right. So the other thing we did was, if it was the cost, instead of 1.03 minus 0.13, it would be 1.03 plus 0.13, and every other process remains the same.
Okay. All right. Thank you.
All right. You're welcome. Okay, so that's that. Just to explain that. The other one is, like I said, we have to be quite fast today. I just want to pick on the very important things because there are so many formulas and words and different things here, but you just need what you need to pass, or else you will just drown in the whole this thing. Okay, so the next one is forward contracts on currencies. This one is very simple, which we will talk about in economics, but it's just a formula you need here, which is 1 plus interest rate of the price currency over 1 plus interest rate of the base currency times the spot exchange rate. Price and base currency will be discussed in economics, but to explain okay, so let's use this example to explain. I can explain price and base currency. So consider a situation where t is equal to 0, risk-free rate in euro is 3%, risk-free rate in dollars is 2%. So you've been given two interest rates. So the question is, how do I know which country is going to be the numerator, which country is going to be the denominator? And the current exchange rate is 1.1. So you are 1.1 is this spot exchange rate. We'll examine the arbitrage transactions that are established by looking at the trades for an investor based in the US that seeks to profit from the higher interest rate on euro. So you've been given USD over euro. So your base rate is usually the rate you have at the end. So in this case, your base rate is euro. So you have, so to fix this formula on its own, is to just say 1.1 times, so your price rate is USD. So 1.1 times 2% over times 1.1 plus 2% over 1 plus 3%, basically. That's to get this forward exchange rate. I don't want to bore you with all the borrowing one currency, getting the next currency. You don't need to stress yourself about those ones. Okay, so just get the formula. This is what you need here, basically. Okay. So I will move. Okay, valuation of forward contracts. So we've basically spoken about this before. The next two readings, forward contract and options, we've basically spoken about them before. It's just to touch on them a bit, basically. But we've spoken about them before. All right. So consider a forward contract that is initially priced at its no arbitrage value of this. Remember this one we've spoken about. It will keep coming up. That's why I said this formula is very important. It will keep coming up in everything that we do. So I don't want to bore you with all the calculations. Like I said, there are a lot of in and out here. But at the end of the day, this is what we just did. This formula you see here is what we have just calculated. So all you need to know is that formula we have calculated, which is the one we said, if it is a benefit, we deduct it from the risk-free rate. If it is a cost, we add it to the risk-free rate and we get our answer. That's basically what you need. So don't stress yourself with all the, you will not be asked to calculate all these things. So don't be worried about that. So the other thing that we need to now understand is, okay, so this forward rate interpretation and all, this one is 1 or 2 marks, but you need to understand what it means. The interpretation of the forward rates. So forward rates are yield for future periods. The rate of interest on a 1-year loan to be made 2 years from today is a forward rate. So you see, the first thing is you look at, okay, so the notation for forward rates must identify both the length of the loan and how far in the future the loan will be borrowed. So a 1 year is 1 year loan 1 year from now. So a 2-year 1 year is a 1 year loan to be made 2 years from now. So like that. So all you just need to understand is where you see. So in this case, you have, so let me take this one. The 2-year forward rate 3 years from today is this. So the number of years. So the two things you have here is you have the length and how far. So the first year, the first number you see on this thing is how far it is going to be. So this 3 is 3 years from today. Then the second number is the length. Is that clear? So what you need to just know here is once you see 2 numbers, the second one is the length. I think that's easier to catch. The second one is the length of the loan or the length of the forward. So this F32 it's a 2-year forward, but it's starting 3 years from now. So the first number you see is when is it starting? Then the second number you see is the length of the period. Okay? So you see this one also. This is 3M, 6M, which is, remember we said the second one is the length. So this is a 6-month period, but it is starting 3 months in the future. So 3 months from now is the period it is starting. And then the second year is how long it is going to be. So that you just need to remember. Because these are just easy marks, 1 or 2 marks, but you just need to remember because you'll be asked those kind of questions, basically. Is that clear?
Yes.
Yes.
Okay. All right. So now there's something called implied forward rates. So this is just a quick example. So Consider a 2-0 coupon bond, a 2-year 0 coupon bond, one that matures in 2 years and one that matures in 3 years. So you have two coupon bonds. One is maturing in 2 years, one is maturing in 3 years. Calculate the 1 year forward 2 years rate from now. So remember, the first number is how long. Sorry, the first number is from 2 years from now. When is it starting? So it's starting 2 years from now. The second one is the length. So remember we mentioned that the arbitrage there must be arbitrage so that things equal themselves, so that people don't take advantage of market movements, basically. So what this is saying is there are two coupons, one that matures in 2 years and one that matures in 3 years. So we are assuming that they are all starting. Okay, calculate the 1 year forward rate 2 years from now. So the first one is that you have the 2%, which is this one. As illustrated in exhibit 52.2, lending for 3 years at Z3 should be equivalent to lending for 2 years at Z2, and then for the third year at F21. What does that mean? It means that if I have two coupons, one is 2 years, the other one is 3 years, the difference between the two of them must be that 1 year difference. That 1 year extra must be the difference in the two of them. If it is not the difference, then there is an issue. So for this first one now, it says 2%. Let me see. Do we have the value? Okay, yes, we have the value here. So lending $100 for 2 years is 100, which is the same formula if you are calculating future value. So present value times 1 plus R raised to power N. I'm sure you guys should be aware of that formula. So this is 100 for 2 years, 1 plus R, the rate is 2%, raised to power 2. So the future value is 104. So this is 2% for 2 years. While lending $100 for 3 years results in $100, 1.03 because it's 3% for 3 years, which gives us 109.27. Now, the forward interest rates. The forward interest rate 2 years from now for a 1 year period. Remember this connotation. 2 years from now for a 1 year period must be this value of in 3 years divided by the value in 2 years minus 1. So like new over old minus 1. So if you are calculating difference, basically, must be 5%. So this is the implied forward rate from period 2 to period 3. Remember, we're giving 2 periods. We're giving one that ends at period 2, one that ends at period 3. We're now asked to calculate the difference in between. That 1 year between the second year and the third year, what rate will be there so that there will be balance in the markets, because they are both 0 coupon bonds. So the difference is now the 5.03%. So like I said as well, this is just something that you need to understand. Okay. So we take another example. So this one is consider a 3 month forward on a 6 month MRR. So that's this period. So it's starting in 3 months time. That's the first period. And then it is lasting for a 6 months period. So the principal is $1 million. At settlement in 3 months, the buyer would receive the present value of 6 months MRR. We divide by it because MRR are typically annualized. So in this case, we have an annualized rate. So in this case, we are divided by 2, which was what Michael was trying to do at that other, for that other example. Okay, we take the present value of the difference in interest between the settlement payments at the beginning of the 6-month period, whereas the interest savings will be at the end of the period. So basically, it's the same. Sorry? Okay. So basically, it's the same formula that we used at this same formula. Where is that formula? Where is that? The forward and the spot rates, the interest rate formula. I think it was up here. Yes. Basically, this interest rate formula is what we are trying to use. But in this case, it is interest rates we have, not exchange rates. So that's the difference. In this case, we had exchange rates, but in this case, we have interest rates. So that's why you have, so assume the 3-month MRR is 1.0% and the 9-month MRR is 1.2%. Adjusting for periodicity, the no arbitrage condition for the value is, so which is this 1 plus the 1.2% for the period, which is 9/12, divided by the 1 plus 1% for the period, which is 3/12, minus 1, then times the 12 and the 6 months period, basically, since it's half of the period. Okay. You will not, I don't think you'll be asked to calculate all this. I think there's a place where they said that. So don't worry yourself too much about all this, basically. So the important thing you need to just understand is this one. This is what you need here, which is if you are calculating the rates in between a period, you know that the effective rate or the implied rate must be the difference between 2 periods. That's basically what you need. What you need there. Okay. So can we answer question 1? So question 1 is similar to what we have been discussing before. So
Is the buyer.
For the buyer,
why?
because if an increase in the price is a gain for him, because he gets to buy at that lower price, not at the current price.
Okay. Exactly. Okay. Yeah, very correct. Number 2.
From year 2 to year 5.
Exactly. So very good. Because we said the first one is when it is
Start.
when it is starting. So it's starting 2 years from now. Then the second one is how long it's covering. So if it's starting 2 years from now and it's covering 3 years after that, that means it's 5 years from today. So that's year 2 to year 5, basically. Okay. Do you want to attempt number 3? Even though I will not. I don't think it's too important, but let's see if you can attempt number 3.
I think I want to go with C.
Why is that?
I'm coming. Let me just. I want to.
I think it should be a 2-year forward, 1-year rate.
You guys should read the question carefully.
Okay.
The question says least likely. What that means is based on these 3 things you have been given, which one is least likely?
Should be C.
Now you are
Yeah.
talking.
C. We'll need a year 4 to get C. We'll need a year 4 bond yield.
Exactly. So please, don't let least likely and most likely affect you, because in the exam, nobody will tell you to look at it again. In your mind, you will think you have gotten the right thing. In fact, you will be arguing with somebody outside that you did the right thing. So please, like I always say, once you have questions like this, if it's for you to underline that thing, so that when you are reading the options, is list that will be repeating in your head. List, or most, so that you don't get it wrong. Okay? So you guys are right. For you to be able to get 2-year forward, 2-year rate, it means it will start 2 years from now, and it will be a 2-year period. That is from today, that will be 0 to 4 years. And you don't have any coupon for 4 years here, so you can't get it. For the one that is 1 year, 1 year, that one is easy. It's a 1-year period. It's starting 1 year from now. You have that. It's a 2-year period starting 1 year from now. 2-year forward year starting 1 year. You have that also in the question. So it's just the last one you don't have, which is 4 years. Okay? So that question is almost like a trick question. All right. So I move again. So like I said, I think they just wanted to expand these derivatives so it will look as if there are many readings. Many of these things should just be topics in one reading because we've spoken about them before. Okay? So now we're looking at futures contracts. And we've spoken about this before as well because we spoke about, we said futures contract, when we're saying futures contract is different from forward contract because you have a central party or a financial intermediary who settles daily settlements, right? So if I ask, can someone remind me what initial margin is?
I think the amount you should deposit at the start of the contract in the margins account.
Okay, so then what is maintenance margin? And then what's the difference between the two of them?
Okay, maintenance margin is the minimum amount in your account that must be in your account for the contract to keep on taking place. So if your money goes below that level, they will call you to come and you get a margin call.
Okay, so the margin call, is it for you to bring your money to the maintenance margin or the initial margin?
To the initial margin.
Okay, good. So because there's a daily settlement in the futures, it means, and remember we said that it is a net off. One person is gaining, one person is losing. So every day, one person's money is going up, the other person's money is going down. So at some point, somebody has to pay the other person. So these financial intermediaries, their job to ensure that they take money from A and they give to B. But when they don't have enough money to take from A, there's a problem. B does not care. Remember, I used the example of the betting platform. So people bet their money. I think there was the time, or there were times where people have won interesting amounts. So somebody putting 100 naira and winning 10 million or 5 million, which is extremely weird. So the person will come to the office and say, oh yeah, please, oh, give me my 5 million naira. They will not say, oh, sorry, wait, let's go and collect all the money from all the people that promised that they will bet on the other side of the equation. No, the person doesn't care. He has come to the office. He expects that you already have that money. Just transfer to his account. So it's the same way this is. So to maintain, I remember we said that the reason we have futures different from forwards is that there is standardization, one, and there is the fact that we can trust and rely on the fact that we have a centralized system. So my credit default risk is very low because there's somebody I can trust that is going to take care of my interest. So to establish that, these people will not have to be pursuing people up and down. They must ensure that there is some money that you keep with them. That's why at some point, if the money goes less than the amount they've agreed, they will call you to bring in more money. Meaning you too have to, we'll get to that later. But meaning that you have to have cash to keep giving them. Because if you don't have cash to give them, then it is cancelled. You get, it is cancelled and they will move on. The company will have to use that money you have dropped to settle the other person and maybe look for their own money and add to it to settle the other person. Okay? So basically that's what this is also trying to say in terms of futures, blah, blah, blah. I don't want to bore you with all this. Many of these things, we've spoken about them before. Basically. Okay? So, valuation of interest rate swaps. So this as well, we've also spoken about this one. Because if you remember, we said we have the swap situation is the situation where somebody is moving from, and we said interest rate is like the major example that is usually used for swaps. Somebody is moving from a fixed interest rate to a floating interest rate. And then one of the parties are paying the difference. So what does that mean? I'm owing somebody 5% interest on a particular amount. Then I go to Esther and I say, okay, Esther, let's go into a contract. The interest rate in the market, which is the market reference rate, will keep changing based on market activities. So let's say today that market interest rate is 4%. So what will happen is that you will pay me that percentage, then I will go and pay the person I'm owing the 5%. So if the current rate is 4% and Esther gives me 4%, then it means I will have to look for 1% extra to be able to fulfill my obligation to the other person. But if the rate in the market becomes 6%, it means I will fulfill my obligation at 5%. Then I need to look for an extra 1% to be able to sort out Esther as the difference. So that's basically what this interest rate swap is. And like we said, another thing we also mentioned was we said interest rate swaps are a set of forward contracts. We can see it as a set of forward contracts because at different times where we get different interest rates, somebody is settling somebody is giving somebody money. So it's like at the first, let's say 3 months, we look at the interest. I'm paying my own interest every 3 months. And then this contract with Esther is also 3 months. So at the end of the first 3 months, something will happen. Either I pay Esther or Esther pays me. Or there is no payment if the percentage is equal. That is a forward contract in itself. The next 6 months, again, it happens again. That's another forward contract. So we see swap as a combination of several forward contracts reoccurring until the final contract is actually done. So you see it as they call it the equivalent of a series of forward contracts. Because those series of forward contracts are what we can now say are equal to the fixed rate that we have paid, basically. Okay, but the difference is that, you know, we have said for forward contracts, at the beginning of initiating the forward contracts, it is zero. The value is zero because I have not paid Esther anything. Esther has not paid me anything, basically. So that's also what we said, what we have for swaps. So I think, okay, yeah. So therefore, we can describe an interest rate swap as equivalent to a series of forward contracts, specifically FRA, which is forward rate agreements, each with a forward contract equal to the swap fixed rate. However, there is one important difference. Because the forward contract rates are all equal in the FRAs that are equivalent to the swaps, this would not be zero value forward contracts at the initiation of the swap. Recall that forward contracts are based on a contract rate for which the value of the forward contract at initiation is zero. There is no reason to suspect that the swap fixed rate results in zero value forward contract for each of the future days. Instead, the swap is most likely to consist of some forwards with positive values and some forwards with negative values. The sum of their values will equal zero at initiation. So what that means, what does that mean? Which is the explanation I gave. At some point, it is positive for me. At some point, it is negative for me. So I said if I'm on 5% and Esther is 4%, Esther has to give me that extra 1%. So it's positive for me. But when Esther's rate, which is the market rate, is 6%, I have to look for an extra 1% Esther. So it is moving. At the end of the day, it is still the same. But during the period, there is what we call movement, which is the fluctuation, which is what it says that it will have, some will be negative, some will be positive at the end of the day. Okay? So that is for swap. Also, you have a formula for this swap as well, which I don't think you are even expected to calculate this also. You're not expected to calculate this. Okay. So with the FRAs, the price of a swap is the fixed rate of interest specified in the swap contracts. The value depends on how expected future floating rates change over time, just like I've said. So as floating rates, which is the market reference rate, is changing, that way the value of the asset will be changing. The value of the swap will be changing. At initiation, a swap has zero value. Because like I've said, from the beginning, we're just going into the contract. You're not paying me anything, I'm not paying you anything. Unlike the options which we discussed about earlier. So this one, you're not paying, I'm not paying you. But when the market rate starts moving, then we start looking at payments between myself and yourself and vice versa. Okay? So that is for swaps. So I'm just running through all this because we have spoken about them before, basically. So they are basically the same concepts. Okay? So for these options, which we have also spoken about, but we are just buttressing it. So remember in the option, we said, for example, a call option. We said that if I want to, we use the phone example between Eni and Esther. Eni wants to buy a phone from Esther. Eni has agreed that he will buy the phone for 100,000, for example. That is the exercise price, which is the agreed price today. On the day, that's in 3 months' time. 3 months' time is now here, and the phone in the market is 80,000. Eni will not exercise it because the market price is cheaper than the price he has agreed with Esther. However, he will exercise it if the market price is 120. Eni will say, oh, this is a very good deal. Thank God I had this deal with Esther. I will go to Esther and exercise my option at 100,000, thereby saving 120 minus 100, which is 20,000 naira in the process. So all those explanations we have given before, now they want to start putting terminologies to them. What does that mean? We'll now talk about whether it's in the money, out of the money, or at the money. So we now say moneyness refers to whether an option is in the money or out of the money. So the example I have given you now, where I said INE will buy it if it is 120. So exercising the option means you are in the money. Because it is an option, I will only exercise it if I'm making money out of it. If I'm not making money out of it, I will not exercise it. So not exercising is equal to out of the money. Exercising is equal to in the money. Basically that at the end of the day. Okay? If immediate exercise of the option will generate a positive payoff, it is in the money, which is what we have said. If immediate exercise will result in a loss, it is out of the money. When the current asset price equals the exercise price, exercise will generate neither a gain or loss, and the option is at the money. Okay? So this same thing explains what we have said in the money. So remember we said S, so we need to remember this connotation again, because we'll now use it a lot more now. S is the value of the underlying, and then X is the exercise price, which is the price we have both agreed before. So in this case, it is in the money if S, which is the price in the market, is greater than the price we have agreed. Meaning that our example of 120 and 100. So 120 is S and 100 is X. So because 120 minus 100 is a positive 20, which is greater than 0, then I am in the money. If it is less than 0, which is minus, I will be out of the money and I will not exercise it. Remember we said option is a right, but not an obligation. So you have the power to exercise or not to exercise it. So the moment you see that it doesn't pay me to exercise it, that means you're already at the money. Sorry, you are out of the money. So you just step out of the contract. Is that clear?
Yes.
Do we get because I've spoken about this before, so okay. All right. So it's the same way. The opposite is for the put option. I am selling. I'm going into an option to sell. So I want somebody to give me an option to sell an asset. Therefore, the idea is that since it's an option to sell the asset, it means that the price in the market, if the price in the market is less than the price I've agreed with somebody, then I will go to the price I've agreed with somebody because it pays me. I've agreed to sell a car for 1 million naira. And in the market, that same car is sold for 600K. Of course, I will honor my agreement, meaning I'm in the money. So that's what this is saying here too. In the money put options, if X, which is the agreed price, minus S is greater than 0, then I'm in the money, which is 1 million naira is the price we have agreed, minus 600K, which is the price in the market. So I have a positive 400K. That positive means that I am in the money. So therefore, I will exercise it. And then the opposite, basically. Okay? So, so here we have a call of 40 and a put of 40. And the stock price is 37. So are we exercising or are we not exercising? For the call and for the put option. And then is it in the money or out of the money? Okay, here we are talking about in or out of the money. So is it in or out of the money? That's for the call and the put.
Okay. The call.
Okay.
The call is out of money because
Okay. So, okay, yes. So the call is out of the money because I have said that I am going to buy. The call is to buy. I'm going to buy. And now I agree to buy at 40. But now market is selling at 37. So I'll go to the market and buy at 37. So it's out of the money for $3. And then, of course, so if the call is out of the money, the put is automatically in the money. Okay. So exercise value, we've spoken about this. Intrinsic value is the option at the maximum of 0 and the amount that the option is in the money. That's the exercise value is the amount an option is in the money. If it's in the money, or 0 if the option is at or out of the money. The exercise value is the value of the if exercised immediately. So this exercise value is what we call, what we have been talking about as the value agreed from the beginning, basically. Prior to expiration, an option has time value in addition to its exercise value. The time value of an option is the amount by which option premium exceeds the value and is sometimes called speculative value of option, blah, blah, blah. We've done all this calculation before, where we said, okay, now you have said whether you are in the money or you're out of the money. Okay, after doing that, we need to consider the premium that you have paid. So net, are you making money or you are not making money? That's basically what this is saying. So that's why it took a lot of time to explain that beginning part, because that's basically what we're talking about in the whole course. The forward contracts, the options, the call and the put. Once you understand what call and put is, you are 50 to 60% ready for this exam. So call, put, what happens with the premium? Are you exercising? Are you not exercising? Forward contracts. Once you understand all those ones, you are basically good to go. Okay. And if you remember the example I also discussed last week, where we said, what is the maximum loss? If you remember, what's the maximum loss a seller can lose in a call or in a put? And what is the maximum gain a buyer can get in a call or in a put? So let me run that back. For the call, we use the example to say, basically, okay, let me go back to this call formula. So we said the call here is the price of the underlying minus the exercise price. So if we say that you have agreed to buy a stock for, where is this example? Yes, you have agreed to buy a stock for $40. And now the stock is selling for $37. That means that you will not buy it. So you are out of the money. So we're not even going to discuss that, because you will not buy it because it's more expensive. Then let's flip it. If you now have, they now tell you that the price of the stock is $35 and you have agreed to buy it at, you've agreed to buy it at 30. Let me take it again. So consider a July 40 call and a July 40 put, both stock that is currently selling at $37. Okay. So for a call, so the call option is 40. You have agreed to buy it at 40, but now it is selling at 37. So you will not buy it because it has changed. So if you now say the price in the market is 42, for example, it means that you are going to exercise your option, your call option, or you are in the money, because 42 is more than the 40 you have agreed to buy. So you have a benefit of 2. What does that mean? It means we can keep increasing this stock price. Let's say we take it to 100 again. From 37, we took it to 42. Let's take that 42 to 100. You will exercise your option because 100 is far greater than 40, meaning you are gaining 60 in this case. But remember, the fact that you are gaining 60 means that somebody is losing 60. Meaning that there is no limit. The limit of the seller's loss is the price of the stock. So if the price of the stock goes to 1,000, goes to 200,000, that's how much the seller can lose. That's on the call side. On the put side, we have said that the put is if the exercise price, so in this case, we said the exercise price is 40 and the market is selling at 37. So it means that you would exercise it. Meaning that you have seen that 40 is better than 37, so I will exercise it. So the seller, so let's take an example again. If the price goes from 37 to 30, for example, you will still exercise it, but now you are gaining 10 versus 3 that you are gaining. So it means that as the market price is going down, you are gaining more money, the seller is losing more money. But the maximum the seller can lose in a put is that exercise price that you have agreed. Because what's the worst that will happen? The stock price moves from $37 to $0. That has no value. The maximum benefit you can get is 40. The maximum loss the seller will lose is 40. You cannot lose more than 40. So for the put option, the maximum benefit is the exercise price. And then for the other one, the maximum is almost limitless, basically. Did you get that example? Did you get that explanation? Because I know we spoke about this in the last class. Just wanted to bring it up again. Is it clear?
Yes,
Esther?
it's clear. Yes, it's clear.
Okay. All right. So, okay, so I've taken this one. Okay. So upper bound for call options. So the things we have to look at is we have the ST, which is the price of the stock. We have the price of the stock. We have the exercise price, which is X. Time to expiration, which is basically T. Then the price of the call option and the price of the put option and the risk-free rates. We've spoken about this in the future. Spoken about this before. So the upper bound for the call option, the maximum value of a European call option at any time, T, is the time the share price of the underlying stock. This makes sense because no one will pay more for the right to buy an asset than the asset's market value. It will be cheaper simply to buy the asset itself. At time T, so what does that mean? If, just like you are taking the call option, am I going to exercise my call option, or I leave the call option and go and buy the asset jejely? So if the asset is cheaper than the call option, then I'll just go and buy the asset. That's what this is saying. That's why it will be cheaper simply to buy the underlying asset. At time T, the upper boundary condition for European call is the call less than or equals to the price of the underlying. And at the time T during an European call option life, the upper boundary condition is this, basically, which is basically what I've explained now. For the put option, logically, the value of the put option cannot be more than its exercise price. Remember, I spoke about this. That's the one I said the seller cannot lose more than the exercise price based on the example I gave between 40 and then 0. This will be his exercise value if the underlying stock price goes to 0. Exactly. However, because European puts cannot be exercised prior to expiration. Yes, so that's another thing I should have mentioned. European put is different from American. European options and American options are different. Although in your course, it's only European option we're talking about. But European options are options that can only be exercised at expiration. So you know their expiration dates. But American options can be exercised at any time. That's the only difference. You don't need to worry about American options because everything we're doing is European options. Okay. However, because European puts cannot be exercised prior to expiration, their maximum value is the present value of the exercise price discounted at the risk-free rates. So what does that mean? If you want to know what the value, you want to know what the maximum value of the put is. We have said the maximum value of the put is the exercise price, but you want to know what it is today. So you can get the present value of that exercise price by discounting it with that same risk-free rate. Remember we said if you want to calculate future value, you do present value times 1 plus r raised to power n. If you want to calculate present value when you have future value, you just do future value divided by 1 plus r raised to power n. I'm sure you know these formulas from your other courses. So that's what this is saying. You have to bring it to its present value by discounting it by the risk-free rate. Even if the stock price goes to 0 and is expected to stay at 0, the put buyer will not receive the intrinsic value until the expiration date because it is an European put. Okay? So blah, 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 blah. So this is where you now have basically the formula for the put. Now, the lower bounds for options. Theoretically, no option will sell for less than its intrinsic value, and no option can take on a negative value. For European options, however, the lower bound is not so obvious because these options are not exercisable immediately. To determine the lower bound for European options, we can examine the value of the portfolio in which the option is combined with a long or short position in a stock and a pure discount bond. So what does that mean? At this point, we are looking at a combination of, I think there's a summary somewhere so that we don't get confused. We're looking at a combination of remember the put is that you want to sell, meaning you have the assets, you want to sell the assets. So how do you construct a portfolio that balances out? So for a European call option, construct the following portfolio. 1, a long at the money European call option with exercise price X expiring at time T. A long discount bond price to yield the risk-free rate that pays X at option expiration, and then a short position in one share of the underlying stock, priced at SO equals to X. So the current value of this portfolio is this, basically. So I don't want to bore you with all the calculation. If ST is greater than X, the call is in the money and the portfolio will have 0 payoff because the call pays this, the bond pays this, and we pay this to cover a short position. That is the time. Let me just go straight to what you need. So this is basically, so for the exam, know the price limit, you will not be asked to derive them. Yes. So I don't want to bore you with all those things because you will not be asked to calculate them. I've been looking for this since. So what you need is knowing the limits, which is what we have spoken about. So for the call option, for the put option, let's start with the put option. We have said that the maximum of the put, remember for the put, I have said that since it's exercise price minus stock price. So I'm going to sell at a price at $40, for example. If the price in the price of the underlying, which is S, is 50, I will not exercise. I will go to the market and sell at 50. But if it is less than 40, which is my exercise price, if it's 37, meaning I will exercise my option, I will gain 3. So meaning that the maximum benefit I can gain from that put option is 40, which is my exercise price, minus 0, which is 40. So that's what this is saying. The maximum value you can gain at the exercise price for puts is the X, which is the exercise price. The only thing is that this X has now been discounted to the present value That's all. That's the difference between what you have here and what we have been talking about. This X is now discounted to the present value. So instead of this minus T over T, it could have easily been X divided by 1 over 1 plus RF. But like I said, you are not going to be asked to calculate it. You just need to know it. So European put, the maximum value is the exercise price, and then the present value of the exercise price. That's all you need to know about this put. Now, the minimum value is that you don't exercise it, which is 0 or max of 0, basically. Now, for the European call, the maximum value is the underlying price. Remember, I made that example, that the example I gave you, that if for the call I want to buy, I say I want to buy at 20. I want to buy at 20, and the value of the assets is 50, then I will go ahead and buy at 20. If the value of the asset is 1,000, I will go ahead and buy at 20. So you see that asset will just be going up. So the difference between 50 and 20, 1,000 and 20, that's my benefit. So as far as that asset keeps going up, so the maximum benefit for the call is the price of the underlying, which is S. That's basically what you need. So just remember that the maximum value for the put is the X, which is the exercise price, which is now brought to its present value by dividing it by 1 over 1 plus RF, which you don't need to know because you're not going to use it to calculate anything. You just need to know the limits, basically. Okay? Is that clear? I hope I've not confused anybody. Can I go ahead?
Yes, it's clear.
Please, I'm quite confused. Sorry, please, can you just like take maybe a short summary of everything because I was lost.
Okay. So the general summary is basically this. So there's a put and there's a call. So the question is, what is the maximum benefits and the minimum, sir? Minimum and maximum, but maximum is the main one that you need for the call and the put. For the put, we have said the put is the right to sell something. So do I have the right to sell to sell an item for $20? I will only exercise that item. I will only exercise that option if the price outside is less. But if the price is more, I will not exercise it at all. Therefore, the benefits to me for that option can only be the maximum value of the exercise price. So if I'm going to sell it at 20, if I say I'm going to sell it at 20, if in the market it's 18, I will exercise my 20. If it is 16, I will exercise my 20. My benefit is 20 minus 18, which is 2. 20 minus 16, which is 4. So if that 18, 16 keeps dropping and it drops to 0, that means what if the asset does not even have any value? The maximum I can get is if I just go to the person I had this deal with and say, okay, this is the asset. Oh, I know that in the market it is worthless. But me and you have agreed that you will give me $20 for this asset. Take assets, give me $20. So I have the benefit of $20. That's the maximum I can get. That's for the put. For the call option is the opposite. Because I have said I'm going to buy at $50, for example. In the market, the stock is $70. Yes, the stock is $70 in the market. It means that I'm going to exercise my option because $50 is cheaper than $70. So as far as that stock keeps going up to infinity, I'll just be exercising my option jejely. So it means the maximum value I can gain is the maximum value of that stock price. So if, for example, the stock price was $50, and I said I will agree to buy from somebody for $20. If the stock price moves from $50 to $1,000, I will still buy at my $20. So what does that mean? I'm getting a value of an asset that is worth $1,000 by only paying $20. So the maximum value I will get is that stock price that is going up. That's basically the summary of that. Clear? Okay. Moving on. Okay. So factors that determine the value of an option, the price of the underlying. We've spoken about many of these before, so I'll just run through it. The exercise price, the mixed fee rates, volatility, time to expiration, cost and benefit of holding the assets. We've spoken about all this before. Okay. So you can take time to read this table that explains the effects of a call. When the price of an asset increases, what happens to the call? What happens to the put? We've spoken about that before. Okay. So I move to the put call parity. Okay. So are you guys still with me?
Yes, following.
Okay. All right. So for the put call parity, we're now saying that we want to, which takes us back to balancing, having a balance somewhere. I want to get a put that will equal a call. That's basically what this is. So I have a call on the left side. What put does it have to be for it to be balanced with a call? So let me take it again. So let me start with the put. So for the put, remember I'm selling, right? So a protective put is I'm selling something. So if let's say I'm selling a stock, it means that I have to have the stock first now for me to be able to sell, right? So I have the stock and I'm saying, just like the phone example we used, or the car. Let's use the car. I think we use the car for the put. I have a car with me now. I want to sell that car. But I'm afraid that today the price of that car is 1 million. I'm afraid that by tomorrow the price of that car will have dropped to 800,000. So what do? I go into a put contract with somebody and I say, okay, well, in 3 years' time, I will sell this car to you at 900K. And the person says, okay. So I have two things with me. I have the car, and then that's why it's called protective put. I'm protecting the value of that car. So that in 3 years' time, if in the market, the car is now worth 600K, I've protected the value of that car by going into this put contract with somebody to sell the car for 900K. So that's what this is saying here. The protective put is a share of stock together with a put option on the stock. So I have the stock and I have the put option on the stock. So in fact, I'm hedging my bet. So if, for example, I go back to the car option. If, for example, the value of the car has moved from 1 million to 1.5 million, I don't need to meet this person I've done agreement with to sell 900K again. I have the car. I just go to the market and sell the car gently because I have the car. Then I let this option with this person expire. Right? So that's the put side. For the call side, which is the fiduciary call, it's basically the same thing, but it's just opposite from a different direction. So for the fiduciary call, remember the call is that you are buying. But now in this case, we are now saying you have fiduciary call is a combination of a call. So you have a call option to say, okay, I want to buy an option to be able to buy these assets in the future. But now, in addition to that call, I now have enough money to be able to buy that same asset when it is discounted to its present value. What does that mean? So if you remember, we said for the exercise price, which is the future value, I want to discount it to a price today. so I can know what it is worth today. So the fiduciary call says that I want to buy, okay, so the option of Ini buying a phone. Ini wants to buy a phone from in 3 months' time for 500K. He has agreed a price with her. That's the call option part. But now Ini needs to have enough money somewhere that if he doesn't go ahead with the call option, he has enough money to go to the market and buy the phone. What does that mean? So he has agreed to buy the phone for 500K from Esther in the future. If in the future the price of that phone is now 300K or 400K, you know Ini will no longer go ahead with the call option because the market price is cheaper. But Ini needs to have the cash to be able to pay to buy that phone today if you discount it to the present value. So I take it again. The protection put has two things, which is I have the car, I have the stock, then I have the put option with me. The fiduciary call has two things. I have the call option, and then I have enough cash to be able to invest today so that I'll have enough money to be able to buy these assets in the future. Is that clear? Or should I take it again? Okay. I'll take silence as it is clear.
For the call
Okay, so
option, try
okay.
the fiduciary call option. You said that you have the money today to buy the assets. Is it today or tomorrow or in the future?
Today, you have the money
Okay.
today, and you can invest it in a risk-free return so that by the future you have the money to buy the assets.
Okay.
So remember we were mentioning risk-free. So I have the money today, I put it in an investment. Once this 1 year time or whatever we have agreed, I withdraw the money from my investment, and I have enough money to buy the assets. In fact, I should even have enough money to fulfill the obligation. What does that mean? Since you have asked that question, going back to the phone example, if Ini says he's going to buy it at 500K from Esther in 1 year time, 1 year time now comes, market is selling it at 700K. So already we know it is good for Ini it's a good option for Ini to exercise the call option. But Ini now says, Esther, sorry, I know that we agreed this, but I don't have money. So you see there's a problem. Because he doesn't have cash to exercise the option, he has a problem. So this fiduciary call says that for you not to have that future problem, how much do you need? Let's say you need to invest 400K today, and the interest rates that they will give you from a risk-free return, it will turn that 400K to 500K in 1 year time. So that you just go withdraw your investment from the bank and give Esther the money. Do you understand? So it means you must have both a call option and the ability to exercise your call option. I think that explains it.
Yeah, this is clear.
Yeah, so I must have a call option and the ability to exercise my call option. I think that makes it easier. That's for the fiduciary call. For the protective put, I have my share with me and I have the option to sell the share at a particular price. So 2 things from the call, 2 things from the put. So what is key is that I must know that these 2 things go hand in hand because they must be equal at the end of the day. That's the idea of the put and call relationship. Okay, so so when working with pull and call price, it's important to know that exercise prices on the put and call and the face value of the risk bond are all equal to the exercise price. So what does that mean? It means that using our example of phone, if I take the call option says Ini is going to buy phone from Esther at 500K. That is the call option, which is part of the fiduciary call. The bond or the money I have, which I want to invest, once I invest that money, and they give me interest, it must be equal to that same 500K. Then I flip it to the other side, which is the protective put, which is the person that is selling the phone, which is Esther. So the person on the other side has the assets, which we believe will be valued at 500K in the future, and also has the option, put option on that stock, which is basically 500K. So everything, that's what this is saying. Note that the exercise prices on the puts and the call and the face value of the bond are all equals to the exercise price. So everything in this assumption, for this put call parity to work, it means that everything is equal to the exercise price. So if at expiration S is greater than X, meaning we've spoken about this before. In this first one, the price of the asset is greater than the price we agreed. Meaning that for the person selling, the protective put pays X on the stock, while the put expires worthless. So the payoff is S, which is basically what we have been talking about before. I agree to sell to you at a price, and I discover that the price in the market is greater than that price I agreed to sell to you. Therefore, I will let my option expire, and I will go and buy, I will go and sell to the market who will pay me more money. That's basically what this first one is saying. The fiduciary call pays X on the bond portion, while the call pays X minus X. So the payoff is X. So the payoff is X plus S minus S equals to X. It's all English. What does it mean? The person that bought it, that wants to buy this asset, the difference between S and X will now be added to the X to give us the S at the end of the day. So what this is just telling us the same thing we have said. They will both be equal to S and they will both be equal to X, depending on the situation. This is the example we gave the other time. If you remember our example of $35 and $43, where we said we are having a short call and a long call. The long call is the person buying the call. The short call is the person selling the call. And then we said long put and short put. Basically, the same relationship. That's what this is saying. In either case, the payoff on a protective put is the same as the payoff on a fiduciary call, which we have said before, because there are two sides to the equation. Our no arbitrage condition holds that portfolios with identical payoffs, regardless of future conditions, must sell for the same price to prevent arbitrage. So, blah, blah, blah. The formula tries to merge the two together to say, okay, the call option must be equal to. So this part, this formula is basically what we have said. This S is the stock. So this is the protective put part, this one on the right, which is the stock that you that want to enter into a put option. You have the stock with you plus the put option that you have. That's you on the protective put side. On the fiduciary call side, you have the call option, and then you have the money necessary to buy the exercise price in the future. That's to be able to activate the call option, basically. So that's what this is. So these two on the left must be equal to these two on the right. That's basically what this whole calculation is. So in either case, you are now able to restructure the example or restructure the formula. So this means that the payoff on a long stock can be synthetically created with a long call, a short put, and a long position in a risk-free discount bond. So that means you have to understand the relationships with each of these things. So you'll be asked a question to say, when you have a long stock, so when you are buying a stock, the person that has bought the stock he has to balance it out with, so this means that the payoff on a long stock can be synthetically created with a long call, a short put, and a long position in the risk-free discount bond. So that's to balance the equation out based on these formulas that we have used before, which is where we said the protective put must be equal to the fiduciary call, basically. Okay. So this is just an example of that. So in this question, you have the stock price is 52, the risk-free rate is 5%. You have exercise price is 50, the put price is 1.5. There was no listed quote for the 3-month $50 call. Estimate the price of the 3-month call option. So we want to get what the call option price is. So we have said that the formula, first of all, is the fiduciary call part, which is on the left, is the call option plus the cash to be able to buy the exercise price, which is the exercise price discounted to today's price, which I have said is future value divided by 1 plus r raised to power n. So that is what is on the left side. Then on the right side, you have the stock and the put option. So in this question, we are asked to calculate the price of the call option. So all you need to do is move the present value to the right side. Since it's positive, once you move it to the right, it becomes negative. So you solve for call option. So you're in this question, they say the put price is 1.5, so we have that. The stock price is 52. Now, what is the present value of the exercise? And they've told us that the exercise price is $50, but this $50 is the price it will be in 3 months' time. So we need to discount it to the price it will be today. So this $50 is the future value. So $50 divided by 1 plus R, what's our R? Risk-free rate, 5%, raised to power N. N is 3 months period, which is 3/12. So 50 divided by 1.05 raised to power 3/12 is the present value. And then once we fix this equation, it gives us 4.11. So a question can easily have asked you to calculate what the stock will be. So for you to calculate the stock, you need to rearrange the formula. So this formula is what you are rearranging, this one here. This is the main formula you need. So all you need to do is, what am I calculating? What was I given in the question? What am I calculating? So let's assume we're calculating the put in this situation. All you need to do is move this S to this side. So because it's positive here, once you move it here, it becomes minus, and then you plug in the necessary things in the equation, and you get your put. And vice versa. Okay? Is that clear? Any questions?
It is.
Okay. Very good. Okay. So that's basically what you need for the. Every other thing is just giving examples of how they have reshaped the formula. So they moved, if it is put you want, you put in the formula. If it is call you want, you put, depending, you make it the subject of formula, yes. I'm sure you still do that in maybe quantitative or something like that. Okay, so let's answer number 1.
B.
Okay. Why is that? In fact, I don't even need to ask why. I think it's simple. Number 2.
The underlying asset.
Exactly. So the put call parity we have said is on the left side, you have the fiduciary call, which is the call plus the present value of the exercise price. That's on the left side. On the right side, which is the protective put, you have the stock and you have the
put.
you have the
option.
put. Yes, you have the put option. Yeah. Okay. So, any questions? Any questions? I hope I was not so fast today. Okay, so this is our final reading for the derivatives. Although most of the readings, like I said, are just basically kind of repetitions of some of the things that we have discussed before. Okay, so this is now valuing a derivative using a one-period binomial model. Okay, so I'm sure, so in quantitative method, you will have done binomial model, how to construct it and blah, blah, blah. Okay, so to construct a one-period binomial model for pricing an option, we need one, the value for the underlying at the beginning of the period. That's what we call SO, if you remember, where we have the underlying and we say, okay, this is the value of the underlying today. Then the second thing is the exercise price for the option. So this is the one where we said you have agreed that this is what the exercise price is going to be in the future. We're agreeing it today that, okay, this is what the exercise price is going to be in the future. Then the third thing is returns that will result in an up move and a down move in the value of the underlying over one period. So in this case we are talking about probabilities. Okay, remember everything we are saying is future. We don't know what will happen today or what will happen tomorrow. We know, maybe we know what has happened in the past, but we don't know the present and the future. So what that means is that at the end of the day, we are looking at what are the possibilities on these assets. If it goes up, what would it be? If it comes down, what would it be? And if you remember, probability is the two must be equal, is a 50-50 chance, or not just 50-50 chance, but it must be equal to 100% basically. So at the end of the day, you must calculate what you call a weighted average or a weighted amount, which is if you say probability of going up is 60%, then probability of going down will be 40%. So let's say the probability of going up is 60%, and if it goes up, the value will be 2. 40%, if it goes down, the value will be 1. So you have to do 2 times 60% plus 1 times 40%, basically, to be able to get what the price would be. Basically that, okay? Then you have the last one, which is the risk-free rate over the period. For now, we do not need to consider the probabilities of up and down move. Later, blah, blah, blah. So what you need is the risk-neutral probabilities. That's basically what you need. So let's assume that. Can you still see my screen?
Yes.
Yes, I can see it.
Okay, good. So as an example, we can model a call option with an exercise price of 55 on a stock that is currently valued at 50. So first question I will ask you is, are you exercising this call option or you are not exercising this call option? Let's assume the future value is 50. Oh, no, let's even use this value as it is now. Are you exercising or not exercising?
Exercising.
Not exercising.
Not exercising, sorry.
Ah. Mm-hmm.
No.
Hmm. At the when we are finalizing, that's when you people are still arguing. By now, it should be chorus answer.
No, we're not arguing. We're not arguing. That was just a slip. A slip of tongue.
Okay, let your hand not sleep. It's good for your tongue to sleep, but your hand must not sleep. Okay, so yes, you are not exercising because it's cheaper to go and buy from the market at 50 than to buy at 55 that we have agreed. So I just wanted to chip that in. Okay, so don't worry about all these things on top. What we need is this. Okay, so which is the risk neutrality which you need. Another approach to constructing a one period involves risk neutral probabilities of an up move or a down move. So consider a share of stock currently priced at $30. The size of the possible price changes and the probability of these changes occurring are as follows. So this one is, if there is the probability that there is an up move is 1.15. So for you to get what the down move is just to do 1 divided by 1.15. So you will have a down move at 0.85 and you have an up move at 1.15 basically. So before you get to this, they're supposed to show you how to calculate that. Okay, so in this case, the risk neutrality of up are calculated from the sizes of the moves and the risk-free rate. So we need to use this to calculate the risk neutral probability before we arrive at the final answer. So what does that mean? So here we've been given 1.15, which is the up move factor if it goes up. And the factor for a down move is 0.87. And we have been given the price at 30. So if we say, if the stock starts at 30, if we do 30 times 1.15, what do we have? What do we?
34.5.
Good, we have 34.5. Then if we do 30 times 0.87,
26.1.
26.1. So the next question I will ask is, so now we have two prices. The price can either be 34.5 or the price can be 26.1. So inside these two prices, which one are we going to exercise? Which one are we not going to exercise?
For
When
a
the
column.
price is 34.5.
Good.
you
So when the
exercise.
price is 34.5, we will exercise. When the price is 26.1, we will not exercise. Now, when we are not exercising, what is the value of our option when we don't exercise?
When you say value, as in 26.1.
No.
Okay.
Wow.
When you decide not to exercise an option, what's
Okay.
the value of the option? Okay. So we have said if you don't exercise an option, the value of the option is 0. Because not exercising, you said you're not going to exercise because 26 is less than 30. Right? So meaning if you buy at 30 and the market is 26, you will get a negative difference, right? And we said since it's an option, you cannot have negative. You prefer to have 0 and walk away than to have negative. So meaning if it is at 26.1, you walk away, meaning that the value of that option is 0 to you because you walked away and you did not exercise it. But for the other one that is 34.5, the value of the option to you is 34.5 minus 30, which is the 4.5 you have gained as a benefit. Is that clear?
Yeah, that's clear. Thank you.
Okay, so I think it's the word, is the way I put the question that's kind of confused you guys. So the value of the option, if you remember, we used the formula before. We said the maximum of 0 or the exercise price minus the stock price. So is that formula I just mentioned now. So you have said you will exercise it because 30, which is the stock price, is less than the market price of 34. So in terms of value, you will say 34 minus 30, which is 4.5, is the value to you. That's here we have assumed no premium, remember. And remember when we're calculating, let's say there was a premium of 0.5. The value to you will now be 4.5 minus 0.5, which is 4. That's the value to you because you have to take out your benefits minus the premium. For the other one, which is 26.1, that you are not exercising, the value of the option is 0, but you have only lost the premium which you have given the person. So that's the explanation for that. Okay. So do we have it here? Hold on. Okay, yes. So this is what I was trying to call out. So 30 times 1.5 is 34.5 and then 26.1. So at this one on top, we will exercise. And our value there is what? 4.5, right?
Yes.
Good. And our value for this one is 0. So automatically we have values for 2 of them. Now the question is, now we now go back to how do we calculate? Remember I said probability is calculating, you are calculating the value for one multiplied by the probability of it plus the value for the second one multiplied by the probability of it. But because we are using a risk neutral probability here, we'll not calculate probability of like 50, 100% minus. We're not doing that. We are going to use this. Here is that. So this formula is what we are going to use, which is this formula that we're given here. 1 plus risk-free rate minus the risk of a down divided by risk of the up minus risk of the down. So 1 plus risk-free rate. The risk-free rate which we have been given in this question is, where is the risk-free rate? The risk-free rate is, okay, yes, 7%. The risk-free rate is 7%. So 1 plus 7% minus 0.87. If you remember, I've calculated this 0.87 before, where we said 1 over 1.15. So they gave us the up move factor, which is 1.15. So 1 over 1.15 gives us 0.87. So we have those two factors were what we used here to calculate the up and the down. So that is still the same thing we will use here. So 1 plus 0.07, which is 7%, minus 0.87, which is this one, divided by 1.15 minus 0.87. This gives us 0.715, yes, which is this. Then the balance is now 1 minus this. So this is where the percentage is. So the risk neutral probability of an upside is 71.5%, basically. Then the risk of a downside is 29%. That makes up the 100%. So is this weighting that will now plug into what we have calculated? We calculated the 4.5 and the 0 now, where you said we'll exercise and not exercise. So the 4.5 multiplied by this 70, the upside multiplied by the 72%, plus the 0 multiplied by the 0.285%, now gives us a call option of 3.22. So this is the future value of the call option, 3.22. But when we discount it to the value today, we get 3.01. Clear or is confusing?
It's clear.
Okay,
It's not clear to
very
me.
good. Okay. So let's take it step by step. We're given this 1.15. Let's look at all the things we're given. We're given the share price today, which is 30, right? We're given 1.15, which is the up move factor. So it is going to rise by 1.15. So we now needed to say, okay, what is the decline value? We now did 1 over 1.15 to give us 0.87. We now said, okay, the price of 30 will rise by 1.15, or it will decline by 0.87. We have those two. But what we did not have was, what is the probability of it going up or the probability of it coming down? We didn't have those two. So we needed to calculate them. So the formula for calculating them is now this formula we're given here, which is risk neutral probability of an up move, which is 1 plus the risk-free rate minus the downturn, which we have calculated, 0.87, divided by the 1.15 minus 0.87. So this calculation gave us a probability, which is this 0.715, which is basically 71.5%. So there is a 71.5% probability that the underlying value will go up by 1.15. And there is so 1 minus that will give us the balance, because the 2 must be equal to 100%. Then there's a 0.285 probability, which is 28.5% probability, that the price will go down from 30 and will go down by 0.87. So we have our two probabilities. Then we now went ahead to calculate what it means. Okay, yes, if $30 goes up by 1.15, what does it mean? We said it means that the value will now be 34.5. Then you now ask yourself the question, am I going to exercise or not exercise? And we said we will exercise. When we exercise, what is our benefits? We now calculated the benefit at 4.5. We have that one on the left side of our hand. The second one, we now said, okay, if the price goes down by 0.87, what would the price be? 26.1. Are we going to exercise or not? We are not going to exercise. And our value will be 0 because we cannot lose in the call option. So our value there will be 0. So we have our value for upside, we have our value for downside. What we're now left with is the probabilities of the up and the down. So we now said, okay, the probability of going up is 0.715. So 0.715 times the value we got if we go up, which is 4.5, plus 0.285, which is the probability of going down, multiplied by the value of going down, which is 0. And we added the two together and we got 3.22. So we are saying that 3.22 is the value of our option in 1 year time. Somebody now said, okay, what is the value of the option today? So to get the value of the option today, we now said, okay, let's discount the future value to the present value. That's the 3.22 divided by 1 plus r raised to the power n. So the n here is 1. That's why you just see 3.22 divided by 1.07. So the value today is 3.01. So that's the value of the call option today, based on these probabilities that we have been given. Clear?
Oh, yeah, it's better. Thank you.
All right. I love that. So answer the put option. We have a put option here. So exactly what we have explained for call, but now we have a put option. So you need to ask yourself, in a put option, what am I going to do? So I need you guys to calculate the put option for me.
Okay, with the same upside and downside value.
Exactly. All right. It should be easy. Oh. Do we have issues with the question, or we are just calculating?
Calculating.
All right.
I got 1.038.
1.038.
Yes.
Yes, it's not even. Are you sure?
Yeah, same thing, 1.0387.
As what? As the value
Value
today,
today.
or okay. So you discounted to today's rate. All right.
Yes.
We'll get back to you. You can use this time to reflect on your answer. With other people.
Okay, 1.0382. That is for the present value today.
Interesting. Michael or Michaels.
One 1.04.
Okay. So Esther, can you run me through how you got 1.038?
Okay, so I didn't calculate the I just use this same thing, this 0.75, 0.715 and 0.285. But for the first value is zero because when the price moves up to 3.34.50, the value is zero because it's a put option. So for the second one, it's going to be the 30 minus 26.10, and that will give me that's like 3.9. Then when I added 3.9 multiplied by 0.285, I got 1.11. So then I now discounted 1.11 to the present value using 1.07, and I got 1.0374. If I round it up, that's 1.038.
Okay. All right. So that's clear. Okay. I think I have one or two more questions for you guys. Hold on. Okay. Not this one. Okay. So number one, take your time. Don't be overwhelmed by the big English. Just take your time and use what you know to answer the question. Can you guys see the question? Should I increase the size?
I can see it.
I'll still increase the size to help you. All right. So don't be overwhelmed by the length of the question. It's still the same thing you know. Just try and understand what you need to do. Yes. Ini, do you have an answer for me now?
It's between. I think the answer is between B or C. I don't remember one particular concept, so I can't say.
Okay. Esther, you're almost there. Should I give you more time or I should move on?
Let me just some time.
Okay. Michael, can you explain how or why you think it's C?
Yeah, I think it's C because it says that there's a 50% chance that the stock would 50% chance that would either increase by 12% or fall by 10%, and this 90% of this of 105.22 is 94 point something. So then I kind of remember from the formula, from what they put here is the right formula. That's one I think that made the most sense there out of three of them. But now that I'm reading it again, I feel like B was also kind of right. That's why I say I think
Feel like
yeah, but
you
I'm
feel like
going
B
with
is
C.
also
But
right.
it's kind of right, but I'm going with C because I'm not sure now. I'm saying it out loud.
You that I thought you were the savior.
But I'm going with C, but I feel like B is kind of. Well, I'm done reading it again.
Yeah, so the first thing is that Ini, you have an answer for me. Okay.
Hello?
So I thought you wanted to say something.
No.
Okay. So the first thing is that to get this answer, you need to calculate. First of all, so because there are just slight differences between what the different options are saying. So it's preferable you calculate to be sure that you are not making a mistake. So C is the right answer, first of all. So if it was a calculated guess you did, yeah, your guess is right. But if we want to calculate it, we'll start by, so the first thing is there's a 50-50 chance that it will either be 12% or whether it will increase by 12% or decline by 10%. So the first thing you need to ask yourself is, how do you calculate this. Remember we said that, so you can also use the elimination method, basically, because remember that in our calculation here, we use risk neutral probability. We don't use the normal probabilities. So the option A and option B are talking about normal probabilities, which is 50-50 chance. So I can, based on that, I can eliminate A and B and choose C, first of all. But we're in class, so let's proceed with the calculation. So if it goes up by 12%, how do I calculate that? I've been given the spot price at 105, and I've been told that the exercise price is 100, and we are talking about a put option. So I asked myself the first question, what does a put option mean? It means that I want to sell at 100. So if I see any price greater than 100, I will not exercise. If I see a price less than 100, I will exercise. That's the first thing in my mind. So if you ask me, these are the things you need to first understand. Whether you quickly write it on your question booklet when you get to the hall, or you just have it at the back of your mind. You find a way to remember that first, based on the examples we have given. Okay, so first thing is if it goes up by 12%. So 12% on 105, that's 105 times 1.12 should give me 117.88. So already I have said I will not exercise it if it is high. So 105 is already higher than 100. So an increase will just mean I will not exercise it. So I already get that. That one is 0. I can even decide not to calculate it. The second part is that it's declining. So if it declines by 10%, that's 105 times 1 minus 10%. That will give me 94.73, which they've already given me, in fact, in all the options here. So in the options, all 3 options have 94.73. So of course, as well, I can decide not to calculate it. So I've been given 94.73 as the part I will exercise. So where the work is I need to calculate what my risk neutral probability is because it is not the 50-50 they've given me in the question. So if you remember the formula is 1 plus the risk-free rate minus the probability of a decline divided by the, hold on, let me go to that formula. Excuse me. 1 plus, yes, 1 plus R minus the, where is it? Let me go to, hold on. I just want to get it exactly how we said. Yes, 1 plus RF minus the RD divided by RU minus RD. So we go back here and we have said that in this case, we've been given the risk-free rate. The risk-free rate we've been given here is what? What's the risk-free rate? The risk-free rate here is 0.37. So 1 plus 0.37 minus the rate of the decline, which we have been given here as the 10%, then divided by 1 plus the increase, which is 12%, minus the rate of the decline as well, which we have. So if we calculate, if we put all that together, we will get we'll get a figure which, let me see. Hold on.
I think Mr. Chicks, for me, I think why I made a mistake was that I used the actual percentage increase and decrease. So I used 0.1 rather than 0.9 as the decrease.
Oh, okay, okay.
Yeah.
Okay. Okay, clear. All right, so that gives us the, so if you use 0.9, where's number 2, right? Well, number 1.
Yeah,
Okay.
199 now goes 0.47.
0.9. Yeah, so you get 0.47. So the 0.47, you now plug it into what we have, which is 0.47 times 0. But since you have 0.47, you need to get the other side. So 1 minus 0.47 will give you 0.53. So 0.53 is the lower, 0.47 is the upper. And we have said the upper limit is 0, so we don't even need that part of the equation. All we need is the lower limit, which is 0.53 times 5.27, which we've calculated before. And then we'll get our answer. Don't worry about this. Don't mind them here. Once you do this part of the equation, you will get 2.79. Then that 2.79, you now bring it to a present value by dividing it by 1 plus r. That gives you 2.78. So I think that is what they have here. Yes, so 5.27 times 1 minus this divided by 1 plus r there. So that is that. Is that clear? So it's basically the same process. So you could have, from the beginning, you could have eliminated it by using the 50-50 chance. You would have just picked C since it had neutral probability. Or I think, which is what Michael did, he just looked at the formula in C in the bracket and said, oh, this formula looks closer to what it is that it's supposed to be, and he picked C. I'm guessing that was why he picked it. Or you just do the full calculation. Exactly. Or you just do the full calculation yourself. Whichever one works for you. Okay. So that is all for derivatives. So very important that you guys understand, try to solve questions and understand the call and put. If you remember, I'm very particular about call and put, and understand what they mean to you. It's very important that you understand what they mean to you. And remember, this course is not, you are not supposed to waste a lot of time on questions on this course, because it contributes a very little percentage to the overall scheme. But you have to pass it, and you have to get above 70-75% on it to help you in your general score. But you have to ensure you don't spend too much time, because one of the things that happens in CFA exams is that people spend a lot of time on a particular question and they forget that they have other questions to answer. And every question has the same 1 mark. So why waste time? So if there's something that, if you can use elimination method or 1 or 2 tricks that can help you answer questions faster, then I always advise that you do that. Okay. So any questions for me? I'll take that as a no. All right. Thank you very much, guys. So this is the end of derivatives. I wish you all the best in your exams.
Thank you very much, sir.
All right.
Thank you.
Thank you. Bye.